To my channel. I'm Doris and I'm here to share with you about my stock account update and also today's market. Today my account lost $3,084. Tesla, after posting its earnings shares in the Q4 last year, Tesla has let the tech stocks go higher. Today my account lost, including the post-market, it lost $3,041 or 3.80%. In total, I have lost $24,224.57. So right now the net asset of my account is $76,956.89. Today the SQQQ decreased by more than 5% to below 40, and the DRV decreased by 3.33% to 42.07. Although including the post-market price, it rose by 0.55%. Today, the market demonstrated a gain across most of the industries. Dow Jones Industrial Average rose by 0.61%. Nasdaq Composite rose by 1.76%. S&P 500 rose by 1.1%. Today, the auto manufacturing industry rose by 5.33%, and most of the internet and the tech stocks rose by more than 2%. Oil and gas integrated rose by 2.71%. North American stocks closed higher on Thursday. The Dow rose more than 200 points for its fifth straight session of gains. Tesla was up 11%, leading stocks higher. Investors are reviewing corporate earnings and the latest economic data. U.S. GDP rose 2.9% in the fourth quarter, and initial jobless claims fell to lower than expected, 186,000 last week. U.S. stocks earnings results remain the focus. IBM, a traditional tech giant that closed down about 4.5%, said it beat analyst expectations and expected a weaker than expected free cash flow in 2023, and said it will cut to 3,900 jobs. Tesla closed up about 11%. The company reported better than expected fourth quarter earnings and record revenue. Several airlines have reported financial results. Southwest Airlines lost bigger than expected losses as its results were hurt by massive flight cancelings during the holidays. American airline groups beat expectations for the fiscal fourth quarter. Bill Northey, senior head of investment at Eubank, said, "Clearly, we are at the heart of the earnings season. There was some positive news and some less than so positive news." Investors are also watching for Thursday's economic data. The Commerce Department reported that the annualized gross domestic product (GDP) rose 2.9% in the fourth quarter from the previous quarter, the highest since the fourth quarter of 2023, slightly above average 2.8% forecast by analysts polled by Dow Jones. The Commerce Department GDP report comes as inflation continues in the U.S. and the Fed continues to raise interest rates. Consumer spending rose 2.1% in the fourth quarter, down slightly from the 2.3% increase in the previous cycle, but remained in the positive region. Other data also show that core PCE price index hit an annualized rate of 3.9% in the fourth quarter, the lowest since the first quarter of 2021, compared with 4% expected and 4.87% expected previously. U.S. durable goods orders recorded 5.6 month-to-month in December, the biggest increase since July 2020, and sharply better than expected 2.5%, reversing the previous contraction. Initial claims for state unemployment benefits were 186,000 in the weekend ended January 21st, the lowest since the week ended April 23, 2022, with 205,000 expected and 190,000 lost. After the first quarter GDP data, some investment institutions said the data did not have much impact on the Fed's interest rate expectations. Swaps trading shows an almost 100% chance of a 25 basis point rate hike at the FOMC meeting next week. The market expects 47 basis point rate hikes for the next two meetings, with policy rates expected to peak around 4.92% in June. Sam Bullard, senior economist at Wells Fargo Securities, said, "This seems likely to be the last really positive strong quarterly number we have seen in some time. Markets will study that figure as recent data suggests that economic momentum is continuing to slow. Retail sales in the U.S. have fallen sharply over the past 2 months, and manufacturing appears to have joined the recession in the housing market. While the labor market remains strong, business confidence continues to deteriorate and will eventually hurt hiring. These are clear signs that the U.S. economy is afraid of sluggish growth in 2023, but some economists remain cautiously optimistic that the economy will avoid a total recession and that the economy is likely to experience a rolling recession, with industry activity falling in turn rather than one-time collapse." It was also noted that today's economic data showed rather weak potential domestic demand in the U.S. The combined contribution of household consumption, capital expenditure, and residential investment was just 0.22% to GDP, the lowest since the second quarter of 2020. Inventories and exports combined contributed 2.2%, so that figure basically paints a bleak picture in the first half, when the strong demand was offset by more transient factors. In addition, jobless claims were again lower than expected. While excluding orders for aircraft, durable goods orders were essentially flat and down slightly. It paints a picture of the economy slowing, but companies overall still long for labor. All this forms an interesting contrast and raises the question of whether the potential domestic demand for labor or labor demand ultimately adjusts. Market is also focusing on the U.S. debt ceiling. Debt default would be catastrophic for financial markets, analysts said, but many on Wall Street said they believe policymakers will find ways to avoid default by the ceiling end, though uncertainty will not benefit anyone. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.